Ladies and gentlemen, we have an absolute legend in the personal finance, investing, education space. Brian, how are you doing today, sir?
Doing fantastic. Thanks for the invite.
Thank you. So, Brian, I was going through all your content on Twitter, on YouTube, and I was having a tough time figuring out where to start because honestly, you just have so much good stuff. Kind of using like rule of first principles thinking, I thought it'd be a good place to kind of talk about accounting. It seems like the foundation of all your research is very thorough. When you analyze a stock, is this kind of like your first step of understanding the financial statements?
So when I'm if you gave me a company that I'd never heard of before and said go and analyze this, I would not start with the financial statements. I would
Okay.
start with the business itself. What does the company do? What industry does it operate in? Do I think it has pricing power? Do I think it has a strong competitive position? Do I think it has a moat, etc.? Now, I would never make an investment in a company without reviewing its financial statements because financial statements are a company's report card. It's something that you can actively look at to confirm or deny whether the story that exists about the stock when you're researching the business is true or not. It also can tell you, financial statements could also tell you where the business is in its growth phase. They can indicate to you what metrics you should look at and emphasize the most, what metrics you should de-emphasize, and more. So financial statements are absolutely essential for
Yeah.
looking at, but it wouldn't be the first place that I started.
And Brian, so in terms of the metrics, I see that you're very much into Bill Ackman, Warren Buffett. Those are like the OGs of the hedge fund space. How do you identify which metrics work for you? Because I feel like sometimes Charlie Munger will be like, oh, EBITDA is not the way, and then someone else will kind of contradict that. How do you actually make that decision for yourself?
Well, I like to get a range of opinions from investors that I admire and appreciate and that have track records to back up their claims. I like to think about what they're saying and why they're saying it, synthesize it for myself, and then make my own conclusions. But a really important thing to do before you look at super investors is to ask yourself, what type of investor are they? If you were to look at Charlie Munger or Warren Buffett, they like to invest in companies that have been around for decades, are highly predictable, have cash flow, have strong cash flow coming in, have built a competitive advantage, and in most cases, the companies that they invest in are in the capital return phase of their life cycle. So that is where Charlie Munger and Warren Buffett choose to invest. Big, mature, stable, strong, cash flowing businesses. When you invest the way that they invest, it makes complete sense to emphasize valuation, to focus on the company's moat, to use metrics like return on equity, return on invested capital, to judge the performance of the management team by looking at those numbers, and to completely de emphasize terms like EBITDA.
Right.
If you're the type of investor that's looking at somebody, a growth investor like Mark Andreessen or Kathy Wood or David Gardner, you should ignore all of the rules that Charlie Munger and Warren Buffett come up with, and you
Right.
should instead focus on the rules that those successful growth investors look at. Mark
Right.
Andreessen, when he's making an investment in a startup, he doesn't ask questions about EBITDA. The only thing that he's focused on is market management and growth rate of revenue. That's
Right.
it, because he's looking to find those needle in the haystacks that are going to 1000x his investment. Now, there's
Right.
no right or wrong way to invest, but if you're going to invest like Charlie Munger, listen to what Charlie Munger says. If you're going to
Right.
invest like David Gardner, listen to what David Gardner says, but don't confuse the principles that they put out.
Right. No, I think that's super spot on. And I think another thing to add too, and going through your tweets is realization of this as well, that a lot of investing just requires patience and not trying to do too much either in terms of whether it's like, oh, dollar cost averaging or, consistently buying and selling positions can affect you from a tax perspective. So I think that's like the other thing too from my, I guess, own investing. I typically do like the dollar cost averaging starter pack S&P 500 ETF approach. In your life, when was kind of that moment where you're like, well, maybe I could actually outperform the market?
Great question. So I started to learn about investing in the 2000s.
Yeah.
Back then, Twitter didn't exist, YouTube didn't exist, Instagram didn't exist. The way that you got information and learned about investing was through books.
Okay.
So I read The Intelligent Investor, I read the Motley Fool's books. I read Joel Greenblatt's books, any book that I could find on investing. And a lot of the investors that I looked up to were stock pickers like Peter Lynch or David Gardner, for example. Now, I also was aware of index funds, and I'm a huge fan of index funds myself. But for what fit my personality best was individual stock picking, simply because I had the desire and the inclination to do the work necessary to find businesses and invest in those individual companies. The reason that I don't think most people should pick individual stocks isn't because it doesn't work or it's a bad strategy. It's simply because 99% of people have no interest in doing the work necessary to find and analyze businesses, which is totally fine. But if you're not willing to do that work, you have no business picking individual stocks.
That ties to this tweet I saw you quote from Jim Cramer, where it's like, it's not buy and hold, it's buy and homework. So I think that truly is like the fundamental reason of like the amount of effort that goes into it. I think maybe majority of people were probably better off in putting their money into an ETF. Going back to that point, right? Like in the early 2000s, there wasn't ChatGPT, there wasn't Twitter. You were just reading a bunch of books. You posted this recent video on YouTube talking about all the things you have to unlearn. For the audience, selfishly, what are like maybe one or two of those things that have changed since you've read those books?
Yeah, so I made a video exactly on what you said, where I kind of took some popularized ideas from the past that I think no longer serve investors. Now, the first lesson that I kind of called out there is in one of my favorite investing books of all time, which is One Up on Wall Street by Peter Lynch. Now, in that book, Peter Lynch makes the argument for something called the PEG ratio. PEG is PEG, or price to earnings to growth ratio. And what it basically said is the higher a company's growth rate, the higher the PE ratio you should be willing to pay. And the inverse is also true. So you take the PE ratio, you divide it by the sustainable estimated growth rate. And if that number is above 2, that stock is too expensive. If it's below 1, that stock is cheap. Now, when Peter Lynch was managing money, he managed money from, I think it was 1979 to 1993, something along something roughly along those lines. When he was managing money, companies were forced to become profitable on a GAAP basis really early in their life cycle. They did not have access to additional funding from venture capital markets or from public markets like they do today. Moreover, there wasn't many examples of companies that were unprofitable at that time and turned into successful investments. You could make a strong argument that the first company to really break that mold was Amazon. Amazon came public in like 1997 or something along those lines, and was famously not profitable for like 20 years, where it was just reinvesting in itself. And it was really the first company that was a very successful stock, even though it did not show GAAP profitability. Companies didn't do that in the 1970s, 1980s, and even the 1990s. So back then, you had to show profits early in your growth cycle. And when you're showing profits early in your growth cycle, the PEG ratio makes a whole lot of sense. Modern day growth companies that have come public in the last 5 or 10 years simply don't report profits that early in their growth cycle. They stay unprofitable for far longer because investors have a much bigger appetite to allow that to happen. And if a company is unprofitable for a long period of time, the PEG ratio doesn't work because there's no E earnings to look at. So I made the case that you should not use the PEG ratio any longer, not because it's not a good metric, simply because it doesn't apply to modern companies for a variety of reasons.
Got it. Dude, that was awesome. That was awesome. Thank you for that. And to that point of profitability, there was another YouTube video. I'm keep plugging your stuff in because honestly, it's good. The video where you kind of differentiate the ways in which an individual can analyze profit. You could look at, what was it, net income, the statement of cash flows, and EBITDA. For you right now in 2026, is there one that you kind of, it's your go-to, or do you use all three and kind of use your judgment from there?
Yep. So there's even more profit metrics than the 3 that you just mentioned.
Yeah.
The one that I look at and emphasize the most depends heavily on where the company is in the business growth phase. As a general statement, I heavily favor looking as far down on the income statement as I possibly can. But there's a
Yeah,
problem, which is what I just highlighted before. I love to use the price to earnings ratio,
yeah.
but that supposes that the company that I'm analyzing is fully optimized for GAAP profitability. GAAP
Okay.
profitability. The E has to be fully realized and mature before the price to the PE ratio can be utilized. If the company is not optimized for earnings, then you are forced to go higher up on the income statement to make a judgment call about the profitability of the business. So sometimes I'll look at price to EBIT if there's something wrong with the company's tax rate or it has a huge interest expense. Other times I'll look at price to gross profit, which ignores operating expenses, but that's something
Okay.
you just have to do when a business is focused on growth above all to measure the profitability of the company. Sometimes I'll use the price to sales ratio, which is not a profit metric at all, but if a company is really early in its development, so much so that the product itself isn't even profitable, that's really what you have to do. My favorite, if you force me to say pick a favorite metric, it would be price to free cash flow. Free cash flow is the measure of how much cash a business is actually generating through normal operations. And some companies actually produce free cash flow earlier than they produce earnings. Many software companies, for example, do that. But a mistake that many investors make is they learn about one metric, like price to earnings in particular,
Right.
and they say, this is the lens that I'm going to judge all companies through. And that is just a completely wrong way to do it because you first have to ask the question, what is the company optimizing for? And
Right.
then you have to make your judgment calls around that number. So it's important if you're an investor to be flexible in the way that you think and judge companies.
Got you. So before you even look at ratios, your mind is just saying, okay, how are they articulating their numbers? What are the, if they're using gap, then I'll kind of steer in this direction with the ratios. Is that kind of the understanding there?
Well, all companies in the United States must use GAAP.
Okay, got you.
That's a requirement. Many companies, especially more recent growth companies, also promote their non-GAAP numbers, which don't conform with GAAP, often because their GAAP numbers look worse than their non-GAAP numbers. But the first thing I ask about any company is, okay, what phase of the business growth cycle is this company in? Is it in the
Right.
startup phase? Is it in the hypergrowth phase? Is it in the operating leverage phase, or is it in the capital return phase? Once I determine where it is in the business growth cycle, then I can focus in on the right profit number to judge something about the company's valuation. But you first have to start with where it is and what management is trying to optimize for before you ask the question about what do I look at.
Got it. So I saw on page 5 of the stock investing school ebook that you have that you break it down by all the different phases: startup, hypergrowth, break even, operating leverage. Is there one in particular that you kind of lean towards, or is you kind of just go based upon the chart that you have here at your own discretion?
Is there a phase that I particularly like to invest in? I assume
Yeah.
that's what you mean. Yeah.
Yeah.
So when I first started investing, and well, uh, 15 years ago when I was picking stocks, I didn't even have that mental model in my mind. But if you asked me where on this chart are you investing, I would have said phase 4. Phase 4 is when a company has reached profitability. The
Yeah.
profitability does not shine through in the financial statements as of yet, and profits are growing faster than revenue. This is where a lot of high quality, profitable growth stocks exist.
Okay.
And if you were to ask me what phase is your favorite, I would probably point towards that one. If you actually look at my portfolio today, it's actually more heavily weighed towards phase 5 companies or those that are in the capital return phase than phase 4. That's not intentional. That what
Right.
what happened was I bought a whole bunch of companies that were in phase 3 and phase 4, held them for 10 plus years. They've matured to the point where they're now capital return companies. For example, the stock that I have held the longest is Google. I bought Google in 2009. When I
Okay.
bought Google, it was in phase 3. It was not fully profitable. It was not fully optimized for profit, any of that. Fast forward to today, Google is now a dividend payer. Google is now buying back stock, right?
Yeah.
So I bought it for the hyper growth, but I've held it all the way through to it being a capital return program. So today, my portfolio primarily centers around phase 5 companies, but I like to put new capital into phase 3 and phase 4 companies.
Nice. And to that point, right? Like you just said, you've been holding Google since 2009. I think one thing that I generally struggle with, and I think a lot of people struggle with, is the timing of when to sell, right? This is like the magical question. In the YouTube video, you kind of debunked the concept of Warren Buffett never sells, right? Like this kind of like the notion he just holds on forever, but you clearly articulated throughout history, he's done it time and time again. Maybe he has a systematic approach, obviously, of winding down. And I think there was one in particular. I forgot what company he was holding for a while. Was it Wells Fargo? And then he's trying to started buying Apple stock. How do you kind of identify when to sell? Because that's honestly a really tough question. But I just want to see your logic.
So selling is 1,000 times harder than buying.
Yeah,
It just is. Learning how to sell well is very difficult. If like when you're analyzing a stock, if all the numbers make sense and the valuation makes sense, buying is easy. I like it. Right? I want to put
yeah,
capital into it. I want it to grow. Selling is extremely difficult because there's lots of different reasons that you could sell. You could sell
right,
because you think the stock is overvalued. You could sell because you think the thesis for that company is broken. You
right,
could sell because you think there's a better opportunity for your money. What you just referenced was exactly what Warren Buffett did. Warren Buffett sold Walmart in like 2012 or something like that.
uh,
He held Walmart for like 20 years. He sold out of it completely so that he could invest it into other companies that he thought had higher growth potential. Maybe it was 2015 when he bought Apple, somewhere around there. But Warren Buffett has long said when it comes to selling, there's opportunity cost, right? So you like something else better. That can be a reason to sell. You don't trust the management team anymore. If the person that's running the company you just have lost all faith in, that can
right,
be a reason to
right,
sell. Or if you think the company is in a permanent state of decline, its business has been disrupted due to some technological change or some business change, that can be a reason to sell. So there are lots of reasons to sell a stock, but I fully acknowledge that I suck at selling as a general statement, and it's way harder to sell than it is to buy.
right. No, I agree for sure. I read this stat, and I don't have the numbers on the top of my head, but it said something along those lines that, like, if you had missed the 10 best trading days in the market, your return would be, I don't know, it was like cut in half or something a lot like crazy like that. And I was like, holy shit, I really am going to have a tough time in timing everything. For the past like 10 years, I've just been holding everything because I don't have like a set strategy on how to wind down on my positions. One big thing that I really appreciate was the video that you talk about moats, and in particular, this was the companies. I believe it was like Alphabet, Adobe, and you break it down into several. So you talk about fortress, stronghold, defended, and under siege. And then you have those drivers of primary moat source, secondary moat source, moat direction, and driver. Let's say you had a particular stock. You looking at the financials first or high level, or are you just kind of off the top of your head trying to break down these different categories?
To figure out if the company has a moat,
Yes. Like, for example, Chipotle, you could kind of high level say, oh, well, their business, they sell bowls. People still go there nowadays. I don't see any disruption. Check mark off that. How does your logic go for that one?
yep. So some companies are easy to identify what the moat is because you know them as a consumer. Others are harder to identify what the moat is. The more important thing is that it's important to think through two things about moat. One is what is the source of your first thought should be this company doesn't have a moat. Period. They should be guilty until proven innocent, right? You
Yeah.
should say you don't have a moat until you prove to me that you do
Right.
have a moat. So that's the first thing in general to say. With a company like Chipotle, the moat is very easy to identify because it's a restaurant. What possible moat could a restaurant have? There's really not that many, right? There's basically brand
Yeah.
value, which I think is definitely the moat that Chipotle has. And then you could also make an argument something to do with switching costs if you really wanted to. Like for example, on my phone, I have 5 restaurant apps. It's like Chipotle, it's Starbucks, it's Jersey Mike's, and like Wendy's. For example, now when my family is in the car and we're deciding last second where should we get something to eat, Chipotle is a damn easy choice because I just load up the app. It knows exactly my history. If I'm traveling, there's got to be a Chipotle nearby and I can order from it. So there are some teeny tiny switching costs to me buying from Chipotle, or at least it's incredibly easy to do so because I have the app installed on my phone. And moreover, there's a network everywhere, so we know exactly what we're going to get when we go to Chipotle. But in large part, the reason that Chipotle has a moat is because of the brand name. And people associate Chipotle
Mm,
with good Mexican food that they want to eat. Now, that's the thought about Chipotle. How do you prove that that happens? You look at the numbers.
right,
What do the numbers say about what Chipotle has done? Well, it's grown fabulously over the
right,
last 20 years as a public company, and same store sales continually go up. And if you dive into the details of those same store sales, mobile orders is a number that they report. And every year, the number of mobile orders that happen through the app just gets higher and higher, which kind of proves out that their investment in those mobile orders are resulting in some level of stickiness of
right.
the customers. But I always start with like a theory of here's what the moat sources could be. And then I look to the numbers that the company produces. They could be on financial statements or they could be key metrics to say, prove to me that this thesis is correct. And that's
Right.
how I go about evaluating moat.
And in proving that thesis, obviously there's been like huge development of AI and using that to analyze statement of cash flows, income statement, balance sheet, whatever you do. I think for high level, most people think this is obviously beneficial. But is there a case in which there is just so much an abundance of information and I guess readily available that everything is just like priced efficiently, or is the markets not really efficient, right? Like, is there things that could still, you could find companies that are undervalued significantly, even though all the financials are available?
Yeah. So you're essentially asking, are markets perfectly efficient if all the information is easily out there and accessible, which is a theory that has existed for many years. And it's one of the theories I tried to bust in that video you talked about previously, which is everything you should unlearn from investing a book.
Yeah,
If you study the markets the way that I have, I think if you come away thinking that markets are perfectly efficient, you are not paying attention to what's happening. If
yeah,
you look at the average company in the S&P 500 and just look at the 52-week trading range of the average company in the S&P 500, the difference between the highest tick of the year and the lowest tick of the year is often 50%. 50%, right,
yeah.
of the average business in the S&P 500. Now, how can every business that's out there in the S&P 500, which are widely known, widely carried, widely followed, have that much variability in their price if markets were quote unquote perfectly efficient? And that's in
Right.
a normal non-crazy year. That's not in 2020. That's not in 2008. That's not in 2001. That's in like a normal, whatever the heck a normal year is for the market. That's in like a non-crazy volatile year. In those crazy volatile years, the variability of the stock prices goes up way higher to like 100% or 200% a difference. So that alone shows to me, okay, if the market can't price big, well-known, well-established, profitable businesses equally over the course of a year, that tells me that no, they're not. They're just not efficient. To say nothing of what happened with GameStop's stock or AMC's stock or any crazy stocks that you've seen out there. I think the correct way or the proper way to think about markets is that stock prices are largely efficient and they take into account most information most of the time. However, plenty of pockets of inefficiencies still exist because at the end of the day, humans are making decisions about whether to buy or sell those stocks. And occasionally the behaviors that drive those decisions can be crazy.
And Brian, what would you say to people right now? They just listen to that and they're just like, "Oh, you see, I told you markets aren't efficient. Stocks is complete gambling." Because I know you're obviously from the perspective that stocks can benefit your life, just like I believe that as well. Again, I believe there's a lot of people gambling with stocks for sure, but still feel like there's so much substance behind it. What would you tell to someone that thinks like stocks is pretty much complete BS, is just like a lottery kind of thing?
Well, the stock market can be a giant gambling machine, or it can be a reliable wealth creation machine. The only thing that separates that one thing from the other is how long you invest for. If you go into the market and you expect to make money in the market in any period less than 3 years, I'd argue that you're gambling.
For
The
sure.
only thing that you're doing over anything less than a 3 year period is hoping that the price of the stock will increase because the popularity or the investor demand for that stock increases during that time frame. So if your holding period is 1 day, 1 week, 1 month, or 1 year, I'd argue what you're doing is akin to gambling. However, what people that say the stock market is gambling miss is they miss the fact that what is behind the stocks that are traded and quoted every single day are real live operating businesses. And if you dive into the results of those companies, you can track in real time what those companies are doing. Is their profit growing or is it shrinking? Are their margins improving or are they diminishing over time? Is the business getting stronger or is the business getting weaker? And you can actually make intelligent decisions based on and projecting the future profitability of companies by looking at their financial statements, looking at their businesses, and then tracking the results over time. To me, if you are saying, I like that company or I like that index, that company has a track record that you can look at. It has a logical reason in your mind, a logical reason for reason why the profits could increase and the valuation is good today. That to me is the definition of investing. You're going into the company with an owner mindset. That to me is investing. So if your mindset is flipping the stock for a profit, you're trading. And trading to me is very close to gambling. If you're going in with an owner mindset and you want to profit from the long-term profit growth of a business, that's investing. So to me, that's the difference.
And in terms of those time frames, what would you look at as a reasonable? It's like to someone to be considered like an investor and not like a speculator. Is that holding something for longer than 3 years? You said.
Yep, exactly.
Okay.
3 years is a rough proxy that I have in my mind. There are absolutely companies that you can tell that they're a winner or a loser well before that. But I would look at a person's turnover ratio, and this is how I judge professional money managers. I look at not only what do they hold, but I look at what is the turnover ratio of that money manager. If the investor's turnover ratio is less than 20%, well, that by definition means they're holding the average stock in their portfolio for 5 years. That's an investor. That's an investor in my mind. Some portfolio managers I follow have a turnover ratio of under 10%, which means their average holding period is 10 years. That
Right.
is an investor that I want to follow and that I want to study. If you're looking at a money manager that has a turnover ratio of 100% or 200%, they're literally turning their entire portfolio over the course of a year. Or more, and to me, that's a trader. I have nothing to learn from that person. So, how long you hold stocks can tell me a lot about what type of investor you are.
Got it. There was this tweet. I don't know if this you retweeted it or you posted it yourself, where you showed this chart of money managers, and something that was like very striking. It was like 60% of money managers, like I think they go bust or they completely obliterate their account. 30% underperformed, and then it was like a small percentage that actually outperformed the market. For yourself, for your content, is this tailored to everyone to kind of like teach them, hey, like you could potentially do this yourself and outperform what professionals do? Because that was the question I wanted to ask you earlier. Like, what made you go this route, the education route, versus like managing a fund or being like a financial advisor?
Yeah. So I think the money management business where you are in control of somebody else's capital is a very tough business to be in. I have personally outperformed the S&P 500 over the last 15 years. But if you gave me other people's money to manage and said do the same thing, I don't think I could outperform the market with their money, because it is way more difficult to manage somebody else's money than it is to manage your own, and that is because of the structural nature of the way that managing money works. When you are managing somebody else's money, the way that you think about investment changes completely because it's not, do I like this stock or do I not like this stock? It's, do I like this stock? And if this stock does poorly, can I explain to the people whose money I'm managing why this stock did poorly or not? So you have to pass your investing decisions through an extra filter, and that filter is, can I explain this decision to the people whose money that I'm managing? That is something that you and I, as individual investors, do not have to do. We don't have to contend with.
Right.
We also don't have to report to anybody over a given time period how our fund did versus some benchmark. And we both know that many people that invest in mutual funds or managers judge those performance of those managers over very short time periods. If they outperform over a 6-month or 1-year period, they get more money. If they underperform, they get less money. This is one dramatically underreported reason why Warren Buffett has the track record that he does. Notice that Warren Buffett is not a mutual fund manager.
Right.
He runs a publicly traded company. He doesn't have an expense ratio. He has access to permanent capital. Yes, he has people to report his investing trades and stuff too, and people do pick at his every move, but because he runs a public company, he has access to way more durable capital. He has way lower costs on a percentage basis, and he's judged over a different time period than professional money managers are. I would go so far as to say if he was a traditional hedge fund manager, that his results would not be as good as they were simply
Huh.
because of the way that of the vehicle that he chose to invest in. So if you gave me $100 million of other people's money and said, do as well as you've done over the last 10 to 15 years, I would say, I can't. I have no ability to manage somebody else's of money. So that's a structural reason why I think professional money managers, professionals, I put that in air quote, underperform the market. It's because of that very fact that they have an extra layer of investment thing that they have to think through.
That was super spot on. I mean, I've experienced this in my own life with some people I know that, let's say they had their money in S&P 500 ETF, and let's say the market went down like 2 months, and they're all of a sudden just like freaking out, asking what's going on, where it's just like the historical data shows that it's continuously upward sloping, and yet people are, grabbing the pitchforks, going crazy just because the market went down a little bit. But dude, Brian, this has been an absolute masterclass. The Stock Investing School ebook is awesome. I was reviewing it this week, just going through the YouTube videos. It's would tell people obviously download it. But please feel free to plug yourself in. Where can people find you? What are your resources, etc.?
So whatever platform you like to get content on, I am probably on. If you're a YouTuber, my channel is called Brian Feroldi. If you're on X, my name's Brian Feroldi. If you're on Instagram, my name's Brian Feroldi. So I try and create content in multiple different formats for multiple different people. But if you like long form content, I would say I do my best work on YouTube.